Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, out to make it actionable, understandable, and clear. What a hot week. Temperatures, and what a show. We're recording this one indoors. I've recorded outdoors before, but boy, 100 degrees, I can't do it. Excellent articles, the producers, the directors, all of the assistants come together, and sometimes it just lines up. We're going to be looking at, I know I keep going back to this one, but the connections that turned a precocious teen into the fallen Nostradamus of AI. So this is that gentleman. You remember he had a large hedge fund that blew up. This is Leopold Aschenbrenners. More lessons. Wall Street Journal article with more lessons. So we keep going back. We also get a little bit of time in the client corner. Excellent questions this week that I want to have everyone benefit from. And then we'll look at a JP Morgan prediction because they just keep coming at us. And if we have time, I don't know if we'll have time. I'll have to see how the producer, if he flags me down or not. But we've got mail call, financial mail call. We've got some advertisements in the mail I want you to look at and appreciate. So let's start at the top. The connections that turned a precocious teen into the fallen Nostradamus of AI. Subheadline, a 24-year-old investor was hailed as a visionary and attracted billions before turning into Wall Street's latest cautionary tale. Now, what was unique about this article is it highlighted what I think are telltale signs that we as humans can really get off course. So I want you to listen. I didn't know all this stuff about this guy. So this gentleman, Mr. Aschenbrenners, again, by way of reminder, he was someone who had a hedge fund. At one point, he had $45 billion. He was using all sorts of financial chicanery and highfalutin techniques with leverage, and he wound up blowing up, basically. He'll be fine. The fund's going to be fine. But this gentleman, listen to this bio. He, at the age of 19, graduated from Columbia University as valedictorian. Again, Columbia University. At the age of 19, he's valedictorian. Now, I'm not saying it's Texas A&M. I'm not saying it's not. But it's a tier 1 university. He's valedictorian. You see how these people, the aura increases. He then, check out this guy's background. He was in the Bahamas. He got to spend time in the Bahamas at one of these compounds that Mr. Sam Bankman-Fried, the infamous gentleman who also had a crypto blow up, but he was there. So he picked up a network there. He then was able to hang out at OpenAI for a while. This is where he really picked up some reputational capital. So are you hearing the story? 19-year-old valedictorian. Let me make it even saltier. This guy took the LSAT, I think on a whim, basically had a perfect score. I think maybe one question away. I would have had a perfect score. Near perfect score. He shared that on his LinkedIn page. We're all promoting ourselves, aren't we? He was accepted to Yale Law School. Again, I'm not saying it's better than Texas A&M's law school. I'm not saying it's worse, but it is a tier 1 deal. He decided, instead of becoming a Supreme Court justice, he's going to go west to the Bay Area. Can you just feel the energy? Can you just sense that this gentleman, so when he walks in a room and he's raising money and he's so young, but it doesn't matter because he's a financial alchemist, people bought the dream. They bought the dream. And so what they did was, they decided to invest in this young man, and all that intellect, all that genius, it doesn't materialize into returns for investors. It just doesn't do it. Now, I have a visitor here who I want just to check in on this, and I'm going to check in with her. She is, the producers bring her in. This is Lucy Carol Hunt. Now, Lucy, if someone's really, really smart, does that mean they're right about everything?
No.
How did you know that? How did you understand that truth?
No.
It's instinctive. You probably listened or produced these podcasts in years past. There was this gentleman, Lucy, who was super, super smart, but he was so smart, he ended up being too complex, kind of messed up. There's a quote by a gentleman named Warren Buffett. He said, beware of geeks with formulas. Can you believe that, Lucy? They said, beware of geeks with formulas. This goes in that. But what I hear this, not all the time, but enough. People will tell me a story on why they're investing with someone, and they give me a bio. It's not necessarily this Nostradamus of AI, this Leopold Aschenbrenners, but it's analogous to it. They'll say this person went to here and they did this and they knew that, they knew that, and great scores. A lot of that matters. Of course it matters. It's wonderful prerequisites. It's not enough to click the button and say, sure, take my money. Not enough. And oftentimes what we can convince ourselves of is we don't have to do our own due diligence. It's the great man theory. We'll just trust this Mr. Aschenbrenner and say, oh, take my money and be an alchemist. Take this stone and turn it into gold. Does not work. And anything that sounds like a shortcut or sounds like it's too good to be true, it probably is in this case. Mr. Aschenbrenner still has gravity affect him like the rest of us. We then are going to enter, and you know what? Before we go into the client corner, I actually want to just pop over to this JP Morgan. It was just too much. So lately, not only have I been thinking this, but plenty, I sit down with client meetings, we think, what's up with this market? A little toppy, a little top heavy. Is it going to keep going up? Lucy, do you ever think about whether the stock market's going to keep going up or down?
No.
Fantastic. How are you so smart to know not to do that?
Because I don't really need to know all that.
Not only do you not need to know that, Lucy, but no one else does. Because what are the three most important things to focus on in investing?
Keep your costs low, keep your investing simple, and keep your time horizon long.
And that's it. Well, JP Morgan, which is a large bank, Lucy, with a lot of degreed people in ties, they have a technical strategist. That's someone who watches the up and down movements of the market and the volume, the number of shares being traded. He said that the AI, artificial intelligence trade, is starting to look like something he's seen before. The last time it looked like this, the market crashed. They're warning us of a market crash. Jason Hunter, JP Morgan's chief technical strategist, told clients the current divergence in AI stocks mirrors what happened in the months before the dot-com bubble burst in 2000. Were you alive in the year 2000?
No.
So you don't remember the dot-com bubble burst? What happened, Lucy? Did you know your father lost money in that episode?
No.
Yeah, I lost money. I bet the entirety of my net worth on a company called Internet America, learned a lot, and I thought it was a great lesson my parents taught me. I bet on internet stock, and I thought I could make money really quick, and I didn't keep my investing simple, Lucy, and therefore I lost my money. Yeah. But anyway, this gentleman's saying it's just like that again. His note published August 21st came as the S&P 500 had recently hit a fresh all-time high of 7,816. Who cares? He's saying conditions could deteriorate quickly headed into September. That's next month. He said the Philadelphia Semiconductor Index is up 87% this year, a little frothy. And he's seen this split before. He's saying semiconductors are up really high, but Meta's down 5%, Microsoft's down 18%. This gentleman says he's seen this split before in 1999. Communications and equipment suppliers surged while companies making heavy capital investment crashed. He's saying, here we go again. It's going to be another market crash. Now, Lucy, does anyone know when the market's going to crash?
No.
You are correct. How did you know that no one knows that?
Because maybe you told me.
That's exactly right. It's only on this you only need to listen to this podcast, Lucy. You are just so on point today. You must be in 5th grade. Is that right?
Yes.
Oh, it's all making sense. You've gotten so old and wise. Well, that's right. It just, no one knows when but here they go. They trot someone out. And I'm always surprised, but I shouldn't be, that JP Morgan has a chief technical strategist, Mr. Jason Hunter. So he's watching this like a hawk for you, for me. It's not actionable. And they go on to scare you with many other things. Treasury yields, oil prices, seasonal weaknesses. These are all market risk, he says. So he's looking at interest rates going up. He thinks that's going to be a problem. And oil is a pressure point because oil is going up. That's a problem. So they're giving us all these reasons why the market could crash. And yet in reality, Lucy, you and I know we're going to keep our time horizon long. We're not worried about like this. Anyway, we just don't need to worry about that. Now, let's enter the client corner. We have some fantastic clients who ask fantastic questions, and I want you to benefit from them. A question this week that I found especially instructive was the idea of not just regular indexing, but fundamental indexing. So there's something called, well, you know this, the index fund, the S&P 500 index fund. Vanguard's ticker is VOO. You've got the Vanguard Total Stock Market, which is U.S. stock markets, ticker symbol VTI. We've got the Vanguard International Index, VXUS. These are all what are called market capitalization indexes, meaning the index matches the size of the company, and that's the index. Well, a lot of companies, now I've got my own philosophy on why they do this, they create different kinds of indexes to try and give you a different flavor of ice cream. So when you go to the ice cream store, Lucy, you probably like seeing lots of different ice cream flavors. What's your favorite?
I like chocolate chip cookie dough.
Chocolate chip cookie dough. Now, do they charge you different for one scoop of chocolate chip cookie dough than they do for one scoop of vanilla?
No.
It's the same price. Now, unfortunately, in the financial intermediation business and the indexing business, they charge different prices. So the plain vanilla is cheaper than chocolate chip cookie dough. So in this analogy, fundamental indexing is chocolate chip cookie dough. Ooh, this is a tough analogy because I love that flavor. But it's more expensive, whereas plain vanilla is what you want to go with. So fundamental indexing, and we'll use Schwab, for example, here. They have indexes that don't just parrot the size of the company. They'll look at earnings. They'll look at other factors, sales, debt, and they'll rank stocks not by the size, not by the market cap, which is the liquidation value, number of shares times the price of the share. They look at different ways. So you'll get a different kind of index, and what they'll show is historic returns, saying these were decent returns, or this is a different way you can insulate yourself from a bunch of market risk because you're going to be in a more fundamental index instead of just putting your sails to the wind with these regular indices. And you know what I think about that, Lucy? You know what I think about investing being more expensive? What do you think I think about expensive investing?
You just have to keep your costs low and keep your investing simple and keep your time horizon.
I mean, she's just on point today, people. She is on point. Yeah, I don't care. And I say this to people. Sometimes folks will bring me historic returns. I don't even think about historic returns. You could show me a fund that earned 40% a year, every year for the past 10 years. I wouldn't touch it. I'd question the returns, of course. As you'll recall, Bernie Madoff showed people 8% fixed returns, and they were contrived. And the fees, and tax efficiency. So these fundamental indexes, we looked into it. They've got about a triple the turnover rate. So they do about 10% turnover, meaning these securities in the fund have to sell out, which has the potential to create capital gains for you, whereas these plain vanilla indices have about 3%. And sometimes those aren't even pushed out at all. So it's more tax efficient to do these plain vanilla. It's lower cost. 0.03% was the plain vanilla index. 0.25% are these fundamental indices that slice and dice based on sales and earnings and whatever. And just keep it simple. So, and it usually shocks people when someone tells me, "Oh, gee whiz, here's this historic return data for fund ABC." It means zero to me. Absolutely nothing. It's not even a data point I put in. I've seen more historic return data in my life that does absolutely nothing for me. And that's a great segue into an advertisement I received. Lucy and I are looking at it. I know you, the listener. You just listen. Thank you for that. You're not looking at it. But we got an advertisement by something called Catalyst Funds, and they gave me a ticker symbol MBXIX, and this is a non-correlated buffer. So this is, if you're, and they know what they're doing. People right now are worried that the stock market is overpriced and therefore we'll have some big crash. Here comes a product to insulate you, so they say, from those crashes. And this mutual fund shows historic returns that, hey, in 2008, this fund was up 5.3%, while U.S. stocks were down 37%. In 2022, U.S. stocks were down 18%. This fund's up 7.7%. Ah, wonderful. You then keep going. You see, wow, this MBXIX, it's even leading. Yeah, it's leading the market through the second quarter of 2026. Wouldn't you know it, guys? The timing of these advertisements is something we should look at with significant suspicion. And let me tell you why. Lucy, and I know I've shared this on the podcast before, but it's a lesson that bears repeating. Did you know that I could have someone mail us a letter 10 times in a row predicting the movement of the market that day. It's possible. Let's say I got a letter in the mail and it said, "Oh dear, Robert Hunt, I'm a market strategist and a prognosticator. I can commit to you the market will go up tomorrow." And the market went up tomorrow. And the second week, I got a letter in the mail saying, "Hey, on Wednesday, the market will be up, not down." And it was so. The market was up, not down, all the way down to the 10th letter. So for 10 days in a row, this prognosticator, futurist has been able to tell me which way the market was going, up or down. How did he do it? How would someone be able to predict something that's unpredictable? Can you think of how someone would do that, Lucy? It's kind of a trick. He started out with a couple hundred people. So imagine if you had 200 people on your list and you told all those 200 people, the market will go up tomorrow, and you mail them a letter. Or you do half and half. Half you say the market goes up, half you say the market goes down. Well, if the market goes up, you ditch the people you said it was go down to, and then you're only left with 100. You then mail another group, half and half. So you keep mailing these letters. By the time you get to the very end, you're down to about one person, but you've been right. That dynamic is occurring with financial product advice. I'm only getting these mailers, not of the bad funds, not of the funds that are dogs, not of the funds that never made it out, see the light of day. I'm getting a curated version of the world, and their headline is "Turning Midterm Election Volatility into Opportunity. How Systematic Investing Powers MBXIX." You see what they're playing on? It's so savvy. It's so smart. Why would you just do the plain old vanilla index, Lucy? You could pay us high fees and we'll navigate these waters for you. Don't you need a captain of the ship? You can't just set sail, let the sails unfurl and let the wheel spin. No, you need a captain at the head. All these things play on our emotions and on the way we think, but we got to fight through it, listener. We're never going to make it if we let these advertisements convince us there's an easy road. We just have to, all you got to do is turn off your brain, give them your money, not think about the price, and it'll all be better for you. We have such angst related to money that it's a very powerful, let's not think we're above it. It's a very powerful thing, fear and greed. But when it all comes down to it, what do, Lucy? How do we invest?
Keep our costs low and our investing simple and our time horizon long.
Because that's what's going to give us the best shot on our investing journey. Till next week.